Swayam Prabha. Digital India. Educated India.
Hello everyone. Today's topic is real estate as macroeconomic indicator as part of the course Real Estate Finance and Investment Strategies. So first, the learning objectives of this class. Understand the relationship between real estate and macroeconomic indicators. Analyze how economic growth, interest rates, employment and inflation impact real estate markets. Evaluate real estate role as a leading and lagging economic indicator. Apply macroeconomic analysis to real estate investment decisions in Indian context. So, what is macroeconomic indicator? So, macroeconomic indicators are statistical data points that reflect the overall health and performance of a nation's economy. So, we know that we have GDP growth rate, which tells us the growth rate of our country, and it's very much there in the news, often followed, and there is a reason behind it, because a small change in that number can basically show great amount of information which can be very useful in projecting the numbers of other sub-sectors in India. So, the overall economy of India impacts the other sector performances, and we can actually analyze different sectors in light of that. And that is why understanding macroeconomic indicators are very, very important. Then we come to the key characteristics. So, we have quantifiable metric measuring economic performance used by policymakers, investors and analysts, help predict future economic trends and influence investment and policy decisions. Example, you have GDP growth, inflation rate, unemployment rate, interest rates, we have industrial production, consumer confidence. So, we talked about GDP growth, we have inflation rate. Inflation basically is something which can tell you the buying, which is telling you the price fluctuation, at what rate it is taking place. So, it can have a direct impact on the overall purchasing power of consumers. Unemployment rate can inform us the current employment status of people in India. And in the last class, we have seen that how IT and ITES employment numbers play a crucial role in Bengaluru office space. And then we have interest rate, we have loans which are directly linked to the interest rate, and the RBI policy is watched by many as their EMIs are impacted by it. And then we have industrial production numbers that tell us that what is the overall production in terms of industries, and what is the consumer confidence level. That is also something which can tell us that how confident people are about the economic situation of the country. So, these are some important indicators which in general are very important for finance, but they are also very important specifically for real estate. So, real estate as an economic indicator, let's get an overview. So, leading indicators, real estate serve as both leading indicator and lagging indicator. So, first, how real estate serve as a leading indicator? It helps to predict future economic trends, right? Then how it can be lagging indicator? Because it reflects past economic performance, right? So, Basically, third one is your coincidental indicator, that it moves simultaneously with economic cycles. So, why real estate basically matters so much? So, it represents around 6 to 7% of India's GDP. It employs over 50 million people directly and indirectly. It reflects consumer confidence and the purchasing power, and influence banking sector health through mortgage lending. We have a detailed discussion about the mortgage lending and how mortgages are also, directly connected with the repo rate, and how the inflation rate actually, the interest rate fluctuations actually impact the EMI for people. So, that we have discussed earlier. So, banking sector has a crucial role in the real estate sector of India. Then coming to the 4 pillars of key macroeconomic factors, we have economic growth, GDP, we have interest rates, employment level and inflation. And these 4 factors collectively determine real estate market performance and investment attractiveness. Now, we will see how. So, economic growth and real estate. So, first look at GDP growth impact on real estate. So, positive correlation. Higher GDP increases income, higher real estate demand, because if you have surplus income, you will definitely think about a very essential part of our life, which is our homes, or a place to live, and real estate demand will definitely rise because of this. Then we have business expansion, which will lead to commercial real estate growth, right? You have we have seen that IT and ITES sector, when they hire more people with a specified number of people, there will be more requirement of office spaces. So, there is a direct correlation in that. So, higher GDP, which translates to all this. Then infrastructure development increases property value appreciation. So, once your property has better connectivity, there is a better infrastructure facility available to reach to it, then of course its prices will go up, because now if you want to go office from a residence, and there has been better connectivity between the 2 points, it will benefit out of it. So, clearly there is a direct GDP growth impact on real estate. Then coming to Indian context, so in India's GDP growth of 7.2% supported real estate recovery. This is, we are talking about this period, GDP growth rate of at different times has been impacting the real estate recovery. Tier 2 and Tier 3 cities showing growth due to economic expansion, right? In Tier 2 and Tier 3 cities, we can see the growth is showing growth due to economic expansion. IT sector growth is driving commercial real estate in Bangalore, Hyderabad, Pune. We have discussed this earlier. And then we have global perspective. You can see that US real estate boom during economic expansion, which happened post subprime crisis. When it settled down, then again recovery started, and the boom period then started again. And there is China's property bubble during rapid GDP growth period from 2000 to 2015. Then real estate contribution to GDP. Now, sectoral contribution, construction is 8 to 10% of the GDP, real estate services 2 to 3% of GDP, and total real estate ecosystem would be 13 to 15% of the GDP. So, that is a significant contribution by this sector to GDP. Now, how that contribution is coming? So, one is your employment generation. there is a direct employment of 12 million people in this sector and indirect employment of 38 million people who are in related fields. And then skilled and unskilled labor, both opportunities are available in this particular sector. Then also we have seen multiplier effect. 1 unit of real estate investment creates 8 units of economic activity. So there is a direct relationship between real estate investment and the economic activity of the country. And it supports 250 plus allied industries, cement, steel, furniture, etc. Then we come to interest rate and real estate. So inverse relationship principle will apply here. Lower interest rates will lead to cheaper borrowing. That will lead to higher demand, right? And higher interest rate leads to expensive borrowing and it will lead to lower demand. So there is a clear inverse relationship. Now we come to transmission mechanism. RBI policy rates changes periodically. Banks adjust their lending rates according to it. Home loan EMIs get affected. Buyers' affordability then changes. And ultimately demand and price then adjust. So this is how the transmission mechanism is there. First, RBI policy rate changes will take place. Very recently, a few days before this recording, there has been a cut in repo rate. So that will adjust, the bank will adjust their lending rates according to that. Then home loans EMIs will be affected because of that, because there is a direct formula now, direct adjustments because of it. And then buyer affordability will change. It will improve because this time there has been a cut, and demand and price adjustment will take place. So there will be this cycle will continue. Sometimes you will see that it will improve, sometimes it will lead to sometimes it will also impact negatively. So this is how the RBI policy will impact the interest rates, will impact the EMIs of people and ultimately the real estate market. Now let's take one case study. So RBI reduced repo rate to 4%. Historic low. Home loan rates dropped to 6.5 to 7%. Housing demand surged by 25 to 30%. And property price stabilized after years of correction. So you can see that how this clearly impacts the overall growth of real estate. Then we go to interest rate cycle historical analysis. So high interest rate periods 2011 to 2014, when we were coming back from the subprime crisis. So repo rate 8.8 to 8.5%, home loans were 10 to 12%. Real estate market slowed down, inventory built up, price corrected. Then we came to 2020 to 2022, lower interest rate period. Repo rate was 4 to 4.4. Market revival, increased sales. Now we have then we had a new project launches resumed. Now coming to global comparison, you have US Federal Reserve rates changes from 2008 to 2022 and European Central Bank negative rates impact also, and Japan's prolonged low interest rate environment. So these are some global comparisons. You can see that how reserve rates or interest rates impact the overall real estate demand and supply. Then we have employment and real estate. So employment as the demand driver. Now job creation is there, increasing job creation. Then income stability leads to income stability of more and more people, which leads to housing demand, and this will basically a direct clear relationship between job creation and housing demand. Then we have key employment metrics. We have unemployment rate. Here we have job creation numbers, and we have wage growth. We also have employment in organized versus organized sector. So these are some key employment metrics which we will be looking at to gauge what will be the impact of employment on the housing demand or real estate. So unemployment rate, job creation number, wage growth, and employment in organized versus unorganized sectors. Now, Indian employment trends we can see. IT sector employment growth leads to tier 2 city real estate boom, right? Or tier 1 city real estate boom. Manufacturing job creation, industrial real estate demand increases. Gig economy growth leads to co-living and flexible space demand, which we can currently observe in many parts of the Bangalore. So this kind of direct correlation we can see between the jobs, and also between the impact on the real estate. Then we go to employment real estate correlation. So IT job growth in Bengaluru 2015 to 2020, 15% annually. Residential prices appreciated also 8 to 10%. Clear correlation. So commercial real estate absorption 40% of national share. So during this period in Bengaluru, we can definitely say that IT job growth was clearly linked with residential and commercial real estate. Then Pune, auto and IT sector employment, affordable housing demand in peripheral areas where the presence of auto and IT sector employees are there, and commercial office space expansion also happened in those areas. And then we have Mumbai Delhi comparison. So we have financial sector jobs in Mumbai versus government jobs in Delhi, different real estate demand patterns, price points and affordability variations are also there, but depending on the kind of jobs, we can clearly see that private sector presence is high in Mumbai, and you will see that because of that there will be a different set of property prices versus in Delhi where the presence of government employees are more. So the clear correlation we can see that there is between employment and the real estate of a place. Then we go to inflation and real estate. So we have general inflation, we have CPI numbers, reduce general inflation CPI numbers. So we have reduced purchasing power. If there is an increase in CPI, the inflation, there is a reduced purchasing power, which affects the affordability. You have less money saved, and real estate as inflation hedge. So real estate, if you have invested in real estate, this is basically acting as an inflation hedge, but also it is impacting your purchasing power. So the real estate will give you more return, but at the same time you should also note that during this period people are losing their purchasing power. Then construction cost inflation. So we have material price increases, steel, cement prices are increasing, labor cost inflation is there, and project viability will get impacted. So you are also getting hit by the material price increase, labor cost increase, and project viability going down because of that. Then third, asset price inflation. We have property price appreciation. Property prices appreciating because inflation is there, everything is rising. So cost of houses will also go high because price price pressure will be transferred, and it will be transferred to the property prices also. And then investment return considerations will be there. You have to think about the returns and risk adjusted returns. And then there can be bubble formation risk because there can be a disproportionate impact of price rise in real estate, because as we know that real estate is acting as an inflation edge. It is helping you gain by real estate. So more and more people will invest, and bubble formation risk may be there. So let's understand inflation dynamics in Indian context. So high inflation period 2008 to 2012, 8 to 12%. Real estate prices increased by 12 to 15% annually. So in relation to inflation, there was more increase in the real estate prices increase. So though you can say that high inflation period led to lower purchasing power of people, but those who were holding real estate, they were getting benefited because of it. And then there was affordability crisis emerged because many people were not able to afford real estate. So, and now in the current scenario, inflation is moderated to 4 to 6%. Construction cost inflation is higher of 8 to 10%, and selective price increases in prime location is taking place. And real estate as inflation hedge, long-term appreciation potential is there, rental income grows with inflation, and physical asset protection against currency devaluation. So currency devaluation is there, then physical asset presence is basically giving you the right protection. So these are some dynamics of, we have seen that how employment impacts the real estate, the GDP impacts the real estate. We have also seen how the inflation plays out and how that impacts the real estate. So basically we can clearly see the interest rate real estate relationship is the most direct and immediate of all macroeconomic connections, right? So that is how, that is, you know, in interest rate we have seen. And then coming to, so we have discussed interest rate, we have seen employment, we have seen GDP, and we have we are now talking about inflation and real estate relationship. So it's not very straightforward in inflation, but still we can understand that real estate can act as a inflation hedge. So it works over longer period of time, and property value and rental income typically grow with inflation, providing protection against the currency devaluation which is taking place. So in that way, real estate has a dynamic relationship with inflation but acts as a hedge for it. Then we go to demographic dividend and real estate. So India's demographic advantage, median age is around 28 years versus 38 globally, 65% population below 35 years, peak earning age entering the market, right? Peak earning age entering the market, and housing demand projection 25 million new household by 2030, urban population growth is 40% by 2030, and nuclear family formation is increasing. So these are the housing demand led projections. So because of these nuclear families and urban population growth, we will have lot of housing demand by 2030. And the policy implication of this will be that we will require more and more affordable housing, and that is why Pradhan Mantri Awas Yojana impacts affordable, right? Affordable housing, and there is a thrust on affordable housing by government. Infrastructure development needs will also rise because there will be lot of urbanization, 40% by 2030. So this urbanization will put more infrastructure demand. There will be more pressure on government to create more and more infrastructure. So that will also be clear. That is also clear that this will be there. The infrastructure development will be required. So this is the connection between demographic and real estate. So more and more houses will be required, more and more infrastructure would be required to basically cater to this fast increasing and growing demographic of India. So, we go to real estate market cycles. We have seen recovery phase, expansion phase, hyper supply phase and recession phase in last class. That in recovery phase we have high vacancy, in expansion phase we have demand exceeding the supply, in hyper supply phase we have overbuilding occurs, and recession there is a deep fall in demand below supply. So, this is the basic fast summary of the real estate market cycles which we had seen in last class. Now, we will see it through the lens of the overall numbers, how the overall growth is impacting that. So, Indian real estate cycle in 2000 to 2008 was boom phase, 2009 to 2014 correction phase, and 3 from 15 to 24 recovery and consolidation phase. Now, this is for overall India, but we had seen one example of Bengaluru where we have realized that in the city itself there are two parts. Commercial real estate might be in the hyper stage, and the residential might be in expansionary stage. So, this is not applicable to each and every city, but in general in India this is what has been the case. Then we go to leading versus lagging indicator. So, real estate as leading indicator, we can talk about construction permits predict the economic activity. So, if there are lot of construction happening, we can clearly see that we are heading towards better GDP numbers. And then land acquisition, if it is growing more and more, it is indicating business confidence, and real estate investment flows signal economic trends. So, basically all these are leading indicators of the economy of the country. And then real estate as lagging indicator will be property prices reflect past economic performance. What has happened in last 1 or 2 years will reflect the property prices, because if the wealth has been accumulated in households and they have enough money that they can go for EMIs and they can maybe invest for new property, they will do it after they have certain amount of money collected and saved. So, this is a lagging indicator. Then rental yields respond to income changes. So, first the incomes will rise. When they will rise, then many people will start looking for newer homes or better homes, and that will lead to pressure on rental yields. The rents will rise, and basically that is also lagging indicator. And then market absorption follows employment trends. As employment increases, initially there will not be any uptick in the market, but in the real estate market, but as the employment is increasing, ultimately it will lead to market absorption will also be impacted by it. So, that is the leading and lagging indication of real estate for Indian economy or for any economic in general. And then Indian examples will be NCR real estate predicted economic slowdown. So, that in 2017-2019, because first the slowdown in NCR took place, and then the the overall economic slowdown happened. So, that kind of happened to predict. And then Mumbai commercial real estate led financial sector recovery. So, commercial real estate sector foretold us that what will be the financial sector situation. So, it recovered, and this is how these leading or lagging indicator of real estate can act in both ways. Then we go to banking sector linkages. So, we have real estate banking nexus. We are talking about home loan portfolio. So, 70 to 80% of retail lending, right? NPAs in real estate is 2 to 3% of total. Interest rate transmission mechanism. So these are your how the bank situation might be. 70 to 80% of retail lending, NPA in real estate 2 to 3% of total, and interest rate transmission mechanism. So all of these are linked to banks, right? Retail lending, a big part of that is for real estate. NPA, at least around 2 to 3% are non-performing. So basically that also impacts bank. And interest rate, whatever interest rate there is there in the fixed by the RBI, that then will be translated to the EMIs of people. So that is how also real estate and banking are connected to each other. Then we have commercial real estate exposure. So direct lending to developers, right? In real estate, commercial real estate, banks are directly lending to the developer. Indirect exposure through NBFCs. So bank are lending to NBFC, and then NBFC are lending to the developer. That indirect exposures can be there. And then asset quality concerns during the downturn. So during the downturns, this NPA situation can accelerate or can increase. So that way also bank is connected to this commercial real estate exposure. And then we have policy implications. So RBI regulate on real estate lending. Priority sector lending requirements are also there for retail, for the residential real estate sector and for the affordable housing. And then we have systematic risk monitoring, which is being done by the authorities. So this way, bank and real estate are connected to each other. Then we have government policy impact. So fiscal policy measures like budget allocation for housing and tax incentives, which have been very instrumental in the buying of homes by people, because many times because of these tax incentive and the savings which can be resulted because of this, people decide to buy homes, buy properties. So this tax incentive which is given by the government, and in the budget there are policies for housing, affordable housing. So they are there by the government. And then infrastructure spending is also announced in the budget by the government. So all these are impacting the real estate sector. Then monetary policy, which is given by RBI. So that is impacting the interest rate policy of the country. And we have seen that how interest rate is directly linked to EMI. Then we have liquidity management. So monetary policy also is fixing the liquidity situation of the money. So that is also impacting the overall money scenario in country. And credit growth targets are also fixed by the RBI for banks. So that is also opening the hands of the banks or not. So how easily they can fund different construction or real estate projects. So that also is governed by the monetary policy. So that is how they are connected. And then regulatory framework, we understand that framework such as RERA has impacted deeply real estate since 2017. GST on real estate has played a crucial role. Now we have Benami Property Act also playing important role for real estate. And then FDI policies in real estate are also playing crucial role. So that is how the government policy is impacting the real estate. Then recent initiatives. So production linked incentive schemes are there, which are there, by the government. So that is some new initiative. Then we have smart city mission, where government has taken an ambitious target of making more and more smart cities in country. So that is there. Then we have PMAY, that is Pradhan Mantri Awas Yojana, huge impact on the affordable housing. So these are some recent initiatives taken by the government for this. So then we have like another so basically production linked incentive scheme boosts the manufacturing, creating industrial real estate demand. So in that way, this is also boosting the real estate demand of the country. Then global real estate indicators. So in US we have housing starts, building permits. So US market track the housing starts and how building permits and as leading indicators there. Then in UK market monitors the house prices, house price indices and mortgage approvals. And Japanese market use land prices, price indices and construction orders to assess market health. Then emerging markets focus on different metrics. Chinese market emphasize property investment. Then they also look at sale volumes. And then Brazil market track the real estate credit growth. And then Russia actually look towards the construction activity indices. Coming to India's position, so India's position in global ranking shows room for improvement. Our transparency ranking of 34 by 100 as per JLL will be indicates scope for better data systems. However, institutional investment is growing and technology adoption is increasing, suggesting improving sophistication. Global integration means international economic trends increasingly affect India's real estate. Global investment trade cycle, commodity price movements and international capital flow all influence our domestic markets. For investors, global perspective help identify best practices, avoid common pitfalls and anticipate trend changes that might flow from international market to India. The key insights here would be the real estate market are increasingly interconnected globally. Understanding global trends enhance the domestic investment decision tracking. Then we go to technology and data analytics. So technology and data analytics are revolutionizing how we understand and predict real estate market movements. So modern real estate indicators increasingly rely on big data and artificial intelligence. Big data sources include online property portals, social media sentiment analysis that can be done through how users are responding to different things in maybe Facebook, X, which was formerly known as Twitter, or Reddit. So such forums, how people are behaving. So that also can be that can also give big data relating to real estate. Then satellite imagery for construction tracking. So that may also be something which can support the big data sources. And then mobile location data can also be something which can add to the insights into population movement and area development. Then we have PropTech innovations, which are AI based price prediction models, blockchain for transactions are there, and then which are bringing more and more transparency. And then IoT for property management, so Internet of Things for property management and making savings in the form of energy and improving the overall functioning of the building. And then virtual reality for sales. So instead of going to the project and then looking at the the flats or the office spaces, you can actually visit them through virtual reality modes which are available, and they are being utilized by sales team in real estate. Then data driven decision making, so real time market analytics, predictive modeling, and there will be risk assessment tools, investment opportunity identification, which will be done through data-driven decision making. So, technology and data analytics integrating with modern real estate and providing the new indicators. Then we have regional variations in India. So, we have seen that in tier 1 cities, we have Mumbai, Delhi NCR, Bengaluru, Chennai. We have, financial sector dependency, government and corporate in Delhi NCR, IT sector correlation in Bengaluru, and auto and manufacturing focus in Chennai. In tier 2-3 cities, government policy impact the highest, infrastructure development is crucial, and local economic factors dominate. Affordability is better than tier 1 cities in city in comparison to tier 1 cities in tier 2, tier 3 cities. And rural real estate, agriculture income dependency is there. Government scheme impact is highly visible in these areas, and infrastructure development needs are always there. So, newer infrastructure developments make clear impact on the real estate. And then migration pattern influence, that is from rural to urban, is also visible. Then we have COVID-19 impact case study, which we can see that pandemic as economic shock was there, immediate impact, lockdown effect on the construction, job losses and income reduction, delayed purchases and decisions, and liquidity crisis in real estate. That was the first thing which was there as the immediate impact in 2020. Recovery phase, which led to work from home trend, preference for larger homes, and tier 2 city migration, because many people started moving back to their hometowns and started working from there. And few of my friends I know are still working from their home in their hometowns instead of where they were earlier working. So, that is kind of work from home trend has remained there. And then government stimulus impact was there during this period. And then what are the lessons learned from this whole thing? The real estate resilience. Real estate was initially impacted, but they came back. For example, the preference for large homes was quickly latched up, and builders started providing that to keep the continuity of the business. And then importance of location became serious discussion, that when it is work from home, location can be anywhere. So, that is how from tier 1 to tier 2 cities or tier 3 cities, there was a movement of people. Then technology adoption acceleration. So, more and more people adopted technology during this period, and that is why retail real estate and office real estate got impacted. And changing consumer preference can also be visible in the form of e-commerce, and that is how the warehousing requirements have also increased. So, there are certain plus and minus impacts on the real estate, but overall real estate has been resilient during this period. Then we go to investment implications. So, using macroeconomic indicators for real estate investment, we have timing the market entry. So, we have economic growth acceleration leads to entry opportunity, right? So, that is there. And then in interest rate cycle bottoming leads to favorable borrowing conditions, right? So, let's take them one by one. So, timing market entry requires monitoring multiple indicators simultaneously. So, for example, economic growth acceleration suggests entry opportunity, but wait for confirmation from employment and income data. Interest rate cycle bottoming provides favorable borrowing condition, right? Employment growth areas indicate higher demand potential. Inflation trend help determine asset allocation decisions between real estate and other investments. And then risk assessment must consider economic recession risk, interest rate volatility, employment stability, and inflation uncertainty. And then coming to your portfolio diversification. So we can understand that geographical diversification can be helpful. Sector diversification, we have discussed that we should have some residential, some commercial, and then risk return optimization should be the goal for portfolio diversification. So these are some investment implications which we can take from this. Then the future outlook and trends. So emerging market factors, climate change is one important impact. Green building demand will be there. Climate resilience requirements are there. Carbon pricing implications will be there. And sustainable development goals shall be there. So these are some impacts which we can understand from climate change. Then digital economy growth. So remote work impact has definitely been felt, and this will be there, that this is something which will remain because of the new technological upgradations by the companies, and so many workers are actually comfortable with new hybrid work cultures, where they go to office for a period of time and stay at their home for a period of time. So a combination of that is working, and that will remain. So accordingly, the real estate and specifically commercial office real estate should prepare for that situation. Then e-commerce space demand is there to stay and may increase also. So the warehousing requirements, the logistic hub requirement will be there. So real estate in that area will become priority for many. And then data center requirements is also rising. So with more and more IT demand, these sectors which cater to them in real estate will definitely they will do well. And then digital infrastructure needs, we can understand, are constantly increasing, and accordingly real estate participants, real estate stakeholders should work on that. Then we have urbanization trends. So that is also, we have seen that million plus cities growth. We have infrastructure requirements climbing up, and sustainable urban development is need of the hour. So government hopefully will work on the infrastructure by 2030, because all the projections are showing that rural to urban movement is on the rise. And then smart city initiatives for building more cities hopefully will help us in settling this issue because of better cities and more facilities to people who are moving towards city. So that kind of outlook and trends we can actually expect will be there. So policy recommendation for investors will be monitor macroeconomic indicators. They should diversify across economic cycles, and investors should consider regional economic variations when they are investing. So any investor who is interested in real estate will definitely must monitor the macroeconomic indicators we discussed, whether it is GDP, inflation, or whether it is interest rate. They should be focusing on them, and because they, as we have seen, they directly impact real estate, and they should diversify across economic cycle. Like for example, they should use recessionary phase, they should use recovery phase or expansionary phase to invest, and diversify their investments in that way, and also consider the regional economic variations. also factor in policy changes impact that may take place. So, once a new policy comes in, they should not hurry up and go with the investment. They should first understand the fine prints and wait for how the implementation will take place and the impact of it will be felt. So, for example, RERA impact which happened in 2017 are still felt. So, that kind of should be done by investors. Then for policymakers, coordinate monetary and fiscal policy. Monetary policy will be from RBI and fiscal will be from the government, central government. So, proper coordination is required in that area. Then monitoring the systematic risk in real estate. So, that is something which should be looked by the regulators very keenly, because that is something which can impact the overall economy and can also be the leading and lagging indicators. And then promote sustainable development, like more and more in this area, and enhance data transparency, bring policies like RERA for greater data transparency, because that helps the stakeholders. And then for industry to adopt technology for better forecasting, so that they can see the cycles before they actually occur, they can plan for it. And focus on affordable housing segment. They should have more focus on affordable housing segment, which is here to stay with the help of government. And then improve project execution efficiency with the newer technologies, and enhance the transparency and governance, so that they can improve overall. So, that is how the overall improvement can take place in this area. So, that is how we have seen here in this particular class the connection between the macroeconomic indicators and real estate. Thoroughly we have gone through different indicators and how they are impacting the real estate, and these interrelationships are very crucial to be understood, and hopefully you have gathered enough knowledge about that from this particular class. So, key takeaways: your GDP growth is directly linked to real estate demand, interest rate with property prices, employment with housing market, inflation with real estate returns, and how they are, we have discussed that in the class. Then success factor would be to understand the local economic drivers, timing market cycle appropriately, and balancing the risk and return expectation, and continuous monitoring of macro indicators. So, all these are basically the important takeaways from this particular session, and please always remember that real estate can become a leading or a lagging indicator, and is very crucial when it is seen with the other macro economic data. So, that is how we can be efficient in real estate investment with that kind of information and knowledge. So, hopefully this session has helped you in that. Conclusion and next steps would be that we summarize basically whatever we have learned, and see that real estate market are intrinsically linked to macroeconomic performance through multiple transmission channels. Understanding these relationship enables better investment decisions, risk management, and market timing. And the key success factor: continuous monitoring of economic indicators, regional and sectoral analysis, integration of global and local factors, and technology enabled decision making. So, overall this is how we have understood that how there is a clear relationship between macroeconomic indicators and the real estate. Thank you so much.